If you don't take these steps, your portfolio could be at risk. I don't know whether markets going to go up, flatline, crash further than they did in February or March, but what I do know is that smart investors are always prepared. Unless you have some kind of crystal ball, I'm guessing you don't know either. But what we both know is that market crashes do happen. So what can you do to prepare for a market drop? I've got 5 tips that will buffer the impact of a market fall. And the good news is that they also provide benefits for you if the market doesn't fall. So really, it's a win-win situation. I'm going to share 2 of them with you now, and you're going to think I'm a little bit crazy because they're kind of counterintuitive. First, if you aren't lending your portfolio yet, you should consider starting. I can hear you now. Why would I lend my securities to a short seller who's going to cause a crash? In fact, I have heard people say that many times. But short sellers don't cause crashes. They participate in them. They might even accelerate them. They certainly profit from them, but they don't cause them. And from your perspective, there's $10 billion in fees out there waiting to be collected every year. And if you are not lending, you are missing out on your share. To my way of thinking, when markets are falling off, every bit of performance counts. Tip number 2 is expand your collateral to the widest range that you still feel comfortable with. If you're not sure about the risks, ask someone. Now, I'm suggesting this because each market crash I've seen, and I've been around for several, has unique features. And by being collateral flexible, you are more likely to be gaining market share while more narrowly focused investors are losing out. More money for your funds while your competitors' portfolios are in free fall. Remember, the biggest risk in securities lending is that the bank or broker-dealer that you deal with goes out of business the way Lehman Brothers did in 2008. I have to give credit to regulators because they've made banks safer since then. More boring, but safer. And if there's no crash, then you make more money anyway, so you've got nothing to lose. I've got 3 other ideas on how you can survive and thrive even in the event of a market crash. Go to my blog post to find out more details about the 2 I've outlined already and discover what the other 3 are. I'll leave a link in the comments below, and I'm also interested in your ideas. What other suggestions do you have to help protect your portfolio and make money in the event of a market fall?